Hello and welcome to the Wendell Effect. My name is Brandon Wendell, Charter Market Technician, and I will be your host as we dive into our first episode here of Chart School. I'm going to be giving you some tips and ideas and insider information from the markets, and hopefully help to make you a better trader and/or investor. Before we get started, just need to remind you that we're not registered broker-dealers or investment advisors. It's purely for educational purposes here, all the information. And I'm not telling you to buy, sell, or hold any particular security. There's always risk of loss no matter what we do in the markets. You can't eliminate that. You can only try to manage the risk and minimize the risk. Past performance is not indicative of future results, and we're not subject to trading restrictions. Anybody here could have a position in security and initiate one at any time. Also, if you want to stay in touch with us, email us at thewendelleffect@tradingmindsetassociation.com, or you can follow me on Twitter at TraderBdub. You can always search for the other videos in this series on YouTube at the Wendell Effect. And we have a website as well to find a lot of this information, tradingmindsetassociation.com. New things going up there all the time, so be sure to check that out. Today, we're going to start talking about understanding something called order flow. I'll give you a little bit of background about myself. I used to be a former broker. That's how I got into the industry. I worked for kind of a little chop shop penny pusher. So if you've seen the movie Boiler Room or Wolf of Wall Street, you get an idea of what I used to do, without all the drugs. But still, we were kind of pushing pennies for what they called rips, or, quick little, well, it wasn't little, but a pretty good size kickbacks, if you will, from the industry. Anyway, I ended up leaving that because I actually have a little bit of ethics and morals. So I've moved into what they call back office operations for another more legitimate brokerage. And what I was doing there was filling orders. I was what they call an agency desk operator. And as an agency desk operator, when the brokers got orders, well, here, let me just kind of show you. A broker would speak to a customer and they would get an order to buy or sell a particular security. Usually it would be stocks. And that's what I was dealing with. So what they would do then is they would write up the order on a piece of paper. They called it a chit. And this is just an example of a couple of different types of chits out there. Mine were actually blue and pink as well, but they didn't quite look the same as these. And I would get, basically, I used to joke, I say, every morning I come in my office, there's this huge pile of chit on my desk to deal with. So, I had this chitty job for a little while, but I got through it. Anyway, the chit would be given to that trading desk for execution. That's what I would do. I would go to my computer and take those chits, those orders that were requested, and try to get them filled at the best available price. I was dealing with market makers, and basically I was dealing with, like I said, institutional customers as well as retail customers, and getting those orders filled by routing them to the market makers. So once I was able to get the order filled, hopefully a little bit better than what they were requesting, because we got to keep the difference as the broker, and I would get bonuses based on my performance as well. And I would just send the notification back to the broker. So you are guaranteed the best price at the moment of execution. But if you were to give me a limit order, I can get a little bit better fill potentially and keep a little bit for the brokerage on top of the commission that they charge you. So that's one of the reasons why you definitely want to trade through what they call direct access trading brokerage. So you skip all the trading desks and you always get the better price. Instead of them keeping it for themselves and passing along a slightly higher but legal price, you actually get the better pricing. So just a little tip there, that those of you who are going into brokerages like Robinhood and stuff like that thinking, oh, wow, there's no commissions. Well, you got to pay for it somehow. And the way you're paying for it is with higher prices on your executions. So again, look for what's called direct access trading. So anyway, that's a little side note here. Let's get back into what we're talking about from the order flow. The way it works, and this is the same whether you're an agency desk operator or working as a clerk on the floor of the exchange, you would basically come into your office and there's the chits sitting on the desk. You would arrange them by orders, and by price. So you had an idea of, okay, I need these orders to get filled. The more orders I fill, the better the more commission the brokerage makes, and the more money I'll personally make with my bonuses, of course. And really, that's what it comes down to, is everybody's trying to make money. That's the brokerage industry. So let's just go from a trader's perspective here. You can see there's a lot of stacks of sell orders here on the right-hand side at different prices, 31, 32, 33, and so on. A lot of buy orders sitting at 29 and below. So if you wanted to buy you got to realize the only way that you can buy a security is if somebody's willing to sell it to you. So if right now you decide to go into this market and buy this particular security at $30, okay, there's nobody there willing to sell at 30. The nearest selling orders are at 31. This obviously only represents one broker's or one institution's orders, but it could be representative of the entire market as well. So if there's nobody there willing to sell to you at $30, we would simply create an order for you and just put it on the desk. And there it is. And it's waiting now for someone to decide to sell at $30. And we match up your order with that seller and you get to buy at $30. Problem is, what if it never gets there? You never get to buy. So what a lot of people will do is say, you know what, the heck with it. I don't mind. It's only $1. I'll go ahead and put in my order at 31 because there is a seller there and you're guaranteed to get your fill for the most part. Almost guaranteed. There's never any guarantees in the markets, but you're pretty much going to get your order because there's somebody there willing to sell at 31. So you get your shares, you take out that order, and everybody's happy. You got to buy at 31, they got to sell at 31, and the broker made a commission on everybody. So everyone's happy. Now, what you'll notice is as prices go higher, the number of orders typically will get larger. And that's just kind of common sense. You figure the higher prices go, the more people are willing to sell because they're going to be making profits at those higher levels. Well, you'll see that, as prices go up, people might be buying from those sellers and they take out those orders at 31. Now, if anybody wants to buy, they're going to buy at 32 and they start taking out those orders. And then they decide, well, people are still buying. There's a lot of buyers. They start buying at 33 and they take out those orders. Well, just because we're seeing more sell orders doesn't mean we're going to be seeing more buy orders. At this point, many of the buyers have disappeared for one of two reasons. Number one, they may have already bought at these lower prices. Or number two, they're not interested in buying at 34 because the price is too high and they're going to wait for prices to return back down to a more affordable level for them in their eyes. So if nobody is willing to sell now, if nobody's willing to buy, and here we are at $34, these sellers start to get a bit nervous. And if they're getting nervous because nobody is buying, the only way for you to attract a buyer at this point really is going to be to lower your price. So what will physically happen is some of these sellers will get nervous enough thinking, you know what, the market's not going up anymore. It might be getting ready to drop. They will drop their prices down to try to attract buyers that are not in the markets as of right now. So that's what happens. This is what causes prices to change direction. If prices are moving up, they will stop going up and turn downwards as soon as we run out of aggressive buyers. As soon as the buyers say, no more, I will not pay this price anymore. If the sellers want to sell, they got to come down to me. Or if prices were dropping, if we run out of sellers because the prices are too low and they just say, forget it, I'll hold on, I don't want to take the loss, the buyers will have to raise their price to attract any sellers and make any transactions. So the turning points in price always occur where either the number of buyers or the number of sellers typically goes to zero. And then the other parties have to become aggressive and either drop or raise their price to conduct business. Now, we can't see this order flow. If you had access to order flow as an agency desk operator, you were actually restricted and not allowed to trade. So what we're going to have to do is kind of imagine this happening on our chart. So when we look at order flow in action, here's the stack of chits. We got all the buy orders down low, all the sell orders up high. And as of right now, we don't know anything's happening here. We don't really know this is demand yet because all we're doing is seeing prices drop and maybe basing a little bit. But now, as we go forward, notice some of the orders were disappearing here. And you can see we had a pretty good sized jump to the upside as prices tried to rise. Okay, now what can cause that kind of a big jump in price? Well, I told you what causes the turn is that we've run out of sellers, right? So typically we run out of sellers in that area. And, think about this. If you were a seller who sold at this level, how do you think you're feeling now that you see the prices went up? Usually you sell because you think prices are going to go sideways or down, not up. So if they end up going up, you're obviously disappointed. And a lot of people, especially in the markets, we will try to avoid pain and try to repeat pleasure. I mean, specifically experiences. If something brings us pain, we're going to try to avoid that in the future. If something brings us pleasure, we're going to try to re-experience that in the future, of course. So if we saw that, hey, you know what, I sold here, that was painful, I'm not going to sell there in the future. As a matter of fact, perhaps you might even buy knowing that prices rose from that area. So that's one thing that we're dealing with here. The other thing you got to be aware of is who is buying and selling in this market. When we take a look at these large stacks of orders, those are not small individual orders from people like you and I trading in the markets. No. I mean, ours are in there, yes. But when you see these large sums of orders, usually those are the big institutions. Now, the problem is if the institutions are all trying to buy, the only retail would be on the opposite side selling, and there's not going to be enough retail customers to fill all those orders. So there's potentially a lot of leftover orders in this area waiting for prices to return back to that zone. So as a matter of fact, when institutions trade, they do what's called working the order. They break their large orders into smaller pieces to try to blend in and not be noticeable in the markets themselves. So what we can do is if we recognize this pattern, and this one happens to be called a drop-based rally, if we can recognize that as a pattern, what we can do is simply put in a buy order when prices return, if they ever return to that area. Now, we're not going to be right all the time, obviously. So what we need to do is put in some sort of protection, like a stop loss, to say, listen, I am taking the chance. You always have to have some sort of risk in order to get reward. So I'm going to take a chance by buying here at this demand zone, expecting the leftover buy orders that didn't get filled previously to bounce price, as well as the fact that we had a lack of sellers. We're probably not going to have sellers there again because nobody wants to sell at a low price when they know they could have sold higher. So that should cause prices to go up. I'm going to buy, but if I'm wrong, I'm only going to take a small loss. That's it. So what you'll see is prices keep going up, and surprisingly enough, they start stalling out when we hit the big stack of sell orders. Notice we took some of the orders out, right? If I go back here, you'll see some of the orders are removed, but not all of them. Okay, so now we've run out of buyers. We got a ton of sell orders. Those sellers start to get nervous. They push prices back down. And look at where we come back down to, the stack of buy orders. Now the institution's feverishly working to get the rest of their buy orders filled. But remember, there aren't a lot of sellers here because they got burned in the past. So unless something's fundamentally changed in this security, we're not likely to keep going down again. And the nice thing is, if we put our order in the right spot, we were able to buy here as well. So we kind of front run, if you will, those institutional orders and try to get filled before they can. So if that's the case, if that actually happens, well, we're off to the races and make our profit. And of course, we'll sell when we reach the stack of sell orders once again. That's it, really. That's what it comes down to when you are trading. Our job as traders and investors is to identify where those pockets are of institutional buyers and sellers and the vacuum, if you will, of buyers and sellers. So if we can find that imbalance between them, now we know where to buy and where to sell. And the nice thing is there's patterns that those institutions leave in the markets, in the charts, that we can identify for high probability opportunities. So hopefully you enjoyed that. I wanted to go ahead and give a little shout out again for these slides. Special thanks to Slides Carnival for the information there. Again, if you want to follow us, here's our information and contact info. If you got more questions, we're going to have many more videos here in the Chart School series. So hope to see you soon. Trade safe, trade well, and take care, everyone.